Good, man. How are you? Yeah, definitely. Yeah, definitely. Thanks for having me here. And happy to talk with you guys today. Yeah, so I'm Squigs. I'm kind of on the operations side at IntentX, and um, basically what I do with IntentX is I'm involved in kind of the content creation, um, and I'm pretty knowledgeable about the backend infrastructure that we use for our trading engine. So helping with that, so more on like the operations and marketing side, and then my background is have been in crypto since 2017. Have done some work in venture capital with respect to crypto, and have just kind of like you guys been a degen in and around the space and in DeFi, pretty much since it started with Uniswap. Yeah, really good question. So for us, it was a couple of um, key distinctions with base in respect to other different chains, like why we chose base. And one of them is there wasn't really like a incumbent perp dex that had launched there yet. So like if we were looking at Arbitrum, obviously like GMX is there, Optimism has Quenta. So base was kind of like a blue sky opportunity for us to be a first mover on base. And in addition, we just think that going into the next cycle, um, base we think will grow to a pretty high degree. With all that being said, we're open to basically any EVM, um, and the beauty of our protocol design is it gives us the because we don't rely on liquidity providers and these pools on each of the different chains or L2s. It allows us to be omni-chain, meaning that we can basically deploy on any L2 or Ethereum itself, um, or EVM that the market makers will support. So it kind of gives us the flexibility to move across chains wherever we want. And I think we're already looking to deploy on Arbitrum relatively soon. Yeah, exactly. And the reason for that is because so with automated market makers, like as I'm sure most of you guys are aware, like you basically are reliant on liquidity pools, and these liquidity pools have to be housed on the chains that the contracts are deployed on. And so to go multi-chain, basically you fragment that liquidity pool. Like if GMX, like when GMX is deployed on both AVAX and Arbitrum, like those are two totally separate liquidity pools. Um, and so, the more chains that GMX goes to, they have to find liquidity to come and, or liquidity providers to come and provide liquidity on each chain that they deploy. Whereas for us, basically, uh, we act as a liquidity aggregator. So market makers, as long as they support the EVM, they can deploy just-in-time liquidity onto any chain that they support. So in that way, we kind of act as like an aggregator as opposed to like a centralized LP. So it just allows us to basically deploy on whatever chain that market makers are interested in putting their collateral on. Yeah, Simio is that's it. Simio. Absolutely, yeah, happy to do that. So yeah, Simio is like the back end infrastructure provider, and we kind of like they aren't a traditional L3 as we would think of them, but it kind of we think that we typically say that they kind of act as like a liquidity L3, where it's like an orchestration engine between basically it's what enables the OTC peer to peer trades that are facilitated on the IntentX front end, and I'll kind of unpack what that means. But basically, the way that the system works from Simio's perspective is there, and I guess from IntentX's perspective as well. Like IntentX is basically the app built on top of Simio. That's the easiest way to think about it. So IntentX acts as the front end to the back end that is Simio. And so what Simio is doing is basically we have market makers or professional market makers that can deploy liquidity uh, to whatever systems on chain that interact with Simio. And Simio acts as kind of like the trading engine, and so or the matching engine rather. And so what happens is like basically market makers, or in our case in IntentX, we call them solvers, is basically they have liquidity both on and off chain. And so, easy way to think about that is 50% of their liquidity is on chain, 50% is off chain. And what they do is basically they have software, market making software that senses price quotes. So this is an Oracle system. They're sensing price quotes from wherever they're hedging their collateral at off chain, which could be Binance, it could be Bybit, OKX, Keycoin, wherever they're hedging off chain is where they're getting their price feeds from. And then they're using those price feeds to stream quotes proactively to the IntentX front end. And so what that means is and why we call it intents is when a trader comes on to IntentX, they put in an intent to trade. And what all that means is they, put in their order parameters, meaning the size of their trade, what pair they want to trade, if it's market or limit order, um, and the leverage and kind of like different parameters of their trade. And so that's their quote unquote intent to trade. And when they input this quote from the market maker based on their price feeds is streamed directly to the trader on our front end. And what our front end does, like the proprietary software on our front end, is we automatically give you the best quote from the market maker, which right now there's only one market maker, but you can imagine as the system grows, ideally there will be many market makers, and then our system basically will provide traders immediately with the best quote for their desired trade. And so that's like when a trader, that's why we call it an intent based system, is because the trader is submitting their intent to trade. And then what happens is if the trader says, okay, like I see this quote, this is exactly the trade I want to take. I'm okay with the funding rate. I'm okay with the fees. I'm okay with the pricing, X, Y, Z. Then they submit what's called a request for trade on the IntentX front end. And basically, when they do that, they're signing a transaction and paying gas. And at that point, they deposit their collateral into one side of the perpetuals contract that's housed in the Simio contract. So their collateral is then committed to that position. Um, and then when they do that, the request is then sent back to the market maker. And so the market maker sees, okay, they accepted my quote. The trader accepted my quote. Now I can go and proactively hedge off chain to basically mirror that trade so that when I take the other side of this trade on chain, my collateral is delta neutral. Meaning, like if I'm going long as a trader, by default, the market maker has to take the short side of my trade. But what they can do is before they open that short side on chain, they can go to Binance and open the exact long position that I have so that they're completely delta neutral on the collateral that they're putting up. And so before they accept the trade on chain, they go and put their order in on Binance. Then they come back and they accept my request, and then they deposit their side of the collateral on chain. And that forms what we call in IntentX this symmetric bilateral agreement on chain. And the reason for that is it's completely protected from external, um, market forces or things like that. Where is if you're a trader, you basically have the programmatic assurance and guarantee that the other side of the trade is locked up on chain. So basically, like there's no solvency risk on chain. Um, so you will always get your collateral back, or basically the market maker can't run away with collateral at that point. And so then, the trade will go through its life cycle, in terms of, P&L will be adjusted and funding rates will be adjusted. And then, it's the same kind of thing in reverse where you request as a trader, you request to close your trade. Um, and then that gets sent to the market, and you again generate your intent for that. You get a quote streamed to you through the IntentX front end. This request to close gets sent to the market maker. They close their position off chain and then accept this. And then you get your collateral back plus or minus any P&L, same to the market maker. And so what the system really allows you to do, or allows like the market maker to do, is basically they're able to remain completely delta neutral on the trade itself, because they have two trades, one that's off chain at the centralized exchanges or wherever they're doing their hedging, and then the one that's on chain. And so they're hedging their on chain collateral. And then you, as the trader, have just the on chain position. And then the incentive for the market maker is they're able to collect the spread on the on chain position versus the off chain position. So they charge a little bit more on their quote, and that's pure profit for them. So yeah, that's I know that was a lot, but that is how the system works in totality. Yeah, that's a really good question. So the one downside to the way that we operate compared to like an automated market maker is, with an automated market maker, it's instantaneous, right? Because you basically, um, like it's all done programmatically on chain. Whereas with us, there is some latency between uh, basically like the market maker accepting your request for trade and them doing their off hedging or off chain hedging operations. So there is a little bit of latency right now with one market maker. I think the most I've experienced is probably like 5 to 10 seconds. Um, so obviously, like price can shift in that window, especially if you're doing like low time frame scalping, and you're at like 60x leverage, like you were saying. So the way that we hope to address that in the future, is to basically like more market makers will help that, because we can net positions, meaning that different market makers can basically all act together to fill one position. So it just happens more quickly. And then the other thing is, we're trying to solve for some ways where, like with a bridging partner or something, where basically you could, uh, you know, these low time frame things potentially get like some collateral lent to you, so that the position can open immediately, and then it gets dealt with on the back end. But that's kind of like in the future. So right now, to your point, there is a little bit of latency, but it's not like you know you're waiting for 5 minutes for the trade to open. Yeah, great question. So as of right now, we do not have take profit or stop loss enabled, but that's kind of like the highest tier item on our priority list to launch with next. So I guess like to caveat, not to caveat, but just as like a disclaimer for the product right now, like this is kind of like our MVP or minimum viable product, but yeah, as Simio's backend infrastructure, they're going through an update soon, and that should enable stop loss and take profit. And then basically, we want to enable a lot more advanced order types moving forward. So that's definitely on our radar, but yeah, not available right now. Okay, hold on. I want to say one more thing with respect to that. So like this slippage that you incur is the way the price moves away from your execution price in our system, because you're only paying, like, there is no slippage because it's quote based, meaning like you get a quote to fill your order, and slippage is this the divergence of the market price versus what you're paying for the order, as opposed to in an AMM, slippage is actually what you take on based on your order size, if that makes sense. So you're still getting the execution price that you're quoted. It just may diverge from the market price by the time the order is actually filled, if that makes sense. Yeah, really good question. So like our major selling point is, well, a couple of things. So in terms of the platform, we can list any pair that a market maker is able to hedge off chain. So right now, the market maker that we're using is only hedging on Binance, but it allows us to offer, the 180 plus pairs that are offered on Binance. But you can imagine that uh, as more market makers onboard that have, these institutional accounts on different exchanges, we can basically offer whatever those exchanges have in terms of their listings. Um, so right now, basically, uh, we have the largest amount of pairs on chain to be able to offer for people to trade. And then the other thing that's a major advantage on the platform level is basically our OI can scale orders of magnitude more efficiently than something like GNS or GMX. And that's simply because in those systems that are based on a local liquidity pool, they have to be over collateralized for the amount of open interest that they can offer. And why they have to do that is because basically they can't have any bad debt in their system, and so they have to operate uh, in in a way that basically means that if there's a total loss of, like, if all traders are successful simultaneously with all of their orders, the liquidity pool has to have enough liquidity to be able to like pay out all of those traders. And so what that looks like on GMX is I think that they basically um, can only give 70%. They can only have enough open interest that's like 70% of their liquidity pool or something. Whereas for us, because these market makers can proactively hedge, it just enables us to be like 100 times more capital efficient. And so with much less liquidity, we can have much higher open interest. So it just enables like scalability of trading to go much higher with what we're offering. And ideally, like if you're an institution or an omega whale trader, like it's really hard to get good execution on GMX. And we're hoping to attract traders with our those level traders with our architecture, because it should just be way more efficient to get them the liquidity they need. And then kind of like the final piece that separates us is more from like a tokenomics perspective. And so the beauty of having market makers be the liquidity providers on our platform is that there's no value dissipation for our token holders. And so basically what that means is like it, in the when we release our token and enable staking, 100% of the platform fees are shared with the stakers of our token. And GMX does that as well, but about 70% of those fees actually go to the LPs because they have to offset their risk. And they also have token emissions that are going to LPs in a lot of these systems. So we have zero token emissions that are going to LPs. We have zero fees that are going to LPs because they're profiting, the market makers are profiting off the spread and not anything to do with our platform, meaning like tokens or revenue share. So basically, like it just enables the stakeholders to gain a lot more value and not be diluted through these liquidity mining incentives. Yeah, I think that's. I mean, you're totally right. That's a really good point, and I think that um, the like that's kind of our goal, and that's our mission, and the way that we do that, different than other dexes, is we basically our infrastructure allows us to offer a sex experience on chain, and by that I mean, we're the only ones offering the pairs that you can get on a sex on chain, and having enough liquidity to be able to facilitate enough, like basically using the same market makers and having the same pairs allows us to be the closest thing on chain that you can get to a sex experience. And so, really, the way that we're trying to bridge those people is to get as close to that experience that they're getting off chain, on chain, and to educate them enough to say, basically, like you can have the same experience that you do off chain, but you have the security of the blockchain, and then also you have self custody over your assets at all times. You have the programmatic assurances of these systems where you know that there's solvency all of the time, meaning that if the exchange goes insolvent, you still get your collateral back. So I think that, to your point, what we're really trying to offer, and we still have a ways to go in terms of the UX UI, but the mission is to basically provide um, as close as we can get to a sex experience, but on chain. Yeah, that's a really good question. I do want to touch one more. I forgot to mention one more thing with the last question, and we haven't enabled this yet, but I think that this is going to be kind of a game changer in terms of the sex experience on chain. Is we're working really hard to enable account abstraction. And so what that means is that basically to log into IntentX and create an account, you can use any Web2 login like Google or Twitter or whatever. And basically on the back end, you can just deposit USDC on any chain that you are interacting on. And we use safe core accounts from Gnosis, and basically what it allows you to do is you can pay gas in any ERC20 through a relayer on their system. And so what it enables you to do is you don't have to worry about what chain you're on, or providing gas in their native token or whatever. All of the bridging is done on the back end. So you just deposit USDC and then you're able to trade. And so we're trying to enable one-click trading in that regard. So again, kind of like that's like the sex experience, but being on chain. And then to your second question about fees, yeah, fees are notoriously high. And so the way to get around that is A, we're deploying on these layer twos. So, gas costs will be more efficient. And then in addition to that, like the way that our market making or the way that our infrastructure works is that we rely on market makers that have these institutional accounts on centralized exchanges. And the one that we're using right now has basically like a zero fee tier on Binance. And so what that means is they don't have to pay any fees when they trade on Binance other than, funding rates. And so what that allows us to do is, they can charge, right now they're the only market maker, so they can kind of like charge whatever fee they want. But you can imagine that when we have more market makers and just with free market dynamics, basically like to get the most volume, they have to be as competitive as possible. And so what we're really hoping for is that as we onboard more market makers, like fees will compress as low as they possibly can. And we may even be able to offer less fees than there are on centralized exchanges because, you know, if in a retail account you have to pay 5% on a SEX, but you're using a market maker that has to pay 0% and the competition is so high that they have to offer 2% fees via IntentX, like it's still cheaper for you to trade on IntentX than it is on the centralized exchange itself. So that's kind of like we hope to get to a point where it's at least on par with the centralized exchange and potentially even lower because you're basically like using the market maker as a middleman to get their lower fee tier. Yeah, so right now, we've kind of just got an agreement with them, and we'll be announcing this later, but we're doing a token swap where we're giving them IntentX or INTX tokens for SIM tokens, and the goal is to get into the highest rebate tier, which, if I'm remembering correctly, is I think it's either 80 or 85% rebate on our fees. So yeah, that's kind of where that goes, but it's still only um, that's coming out of the 4 bips in and out cost. So it's no extra cost to users. It's just what gets shared with our stakers. That makes sense. Yeah, yeah, it's a good point. I mean, there's definitely a supply overhang with respect to kind of the allocations to different stakeholders in the protocol. I will say that with the seed investors, there's a 12-month linear vest. Um, so those will be coming online relatively slowly. And then in addition to that, team also has I think a 36-month vest. Um, so those tokens come online relatively slowly. Um, and and with the team, that's not all of that is like allocated already. A lot of that is just being held for like things like marketing and things like that we may need to use it for, as apart from just like the team is getting. If there's 10 people on the team, they each get X allocation, and that's coming up like that supply will come online. So there's that, and then the other thing is that when we are all of the supply that's under these vesting contracts, basically like when it comes online, it's in the form of the staked token. Um, and if you've read about like how our tokenomics work, basically you we've designed it in a way that incentivizes long-term staking, meaning that if you unstake immediately. So if you receive the tokens, if you're like say like I'm a seed investor and I receive my tokens and I just want to dump, like market dump immediately when I get them. Basically what I have to do is if I want to unstake immediately after I receive the tokens, we have this loyalty period of 16 weeks. So it takes 16 weeks to get to the lowest unstake fee tier, which is 0.5%. But if I want to unstake immediately, I take a 25% hit on the tokens that I'm unstaking. And that 25% just stays in the pool, so that the basically like if you're staking in the pool, there's this ratio of INTX to XINTX. And so what that means is if I take this 25% hit, there's more INTX backing XINTX for the stakers that remain in the pool. So I can exit, but I have an exit penalty. And again, that's over a 16-week period, and it just declines linearly from 25% to 0.5%. And so this is to prevent, you know, it prevents people from like from seed investors or the supply overhangs from nuking their position because there's just a major disincentive for them to do that. And if they do, it helps the people in the pool. Like it may have a negative impact on price action, but they're getting more backing per tokens that they have in the pool or their staked tokens. And then in addition, it incentivizes this like long-term staking mentality. And so the whole system is designed to reward long-term stakers, if that makes sense. So I do understand what you're saying, but hopefully the system will be able to account for that. Yeah, good question. So there's definitely some other things that we can enable in terms of like fees and things like that. But kind of the immediate stuff is if you have with this loyalty duration, basically you can get we've earmarked I think 21% of the supply for these trade to earn incentives after the so we have a retroactive airdrop where points are accumulating right now. So if you trade on the platform, it gives you points, and this is volume based, and then you get reward multiples for being a referral or using a referral, or maybe not multiples, but you get a reward bonus in that regard. But 2% of the supply is earmarked for that. So whenever our TGE happens, based on the amount of points you've accrued from now until the TGE, you get a portion of those 2 million tokens that will be airdropped. And then after that, after our token goes live, like the real trade to earn incentives go live, and this is basically like a daily epoch, wherein uh, based on your trading volume and P&L and potentially some other variables, like you earn over the course of 3 years, we have 21% of this, so 21 million tokens earmarked for those incentives, and so you can gain from those. And the loyalty stake duration. So if you have uh, X amount of INTX staked, you can get a reward multiple depending on how much INTX you have staked. And then for the loyalty duration as well, meaning if you've had it staked for more than 16 weeks, you also get a bonus for your trade to earn incentives. So that just, again, incentivizes kind of the long-term staking. But in terms of like extra utility, um, another thing that we're wanting to do is uh, we really want to create our own internal market maker that's owned and operated by the IntentX kind of like stakeholders. And so what that means is basically like we want to create some, tier system where you have to own a certain amount of staked INTX or XINTX to basically get access to this pool. But if depending on your tier, like basically you can add liquidity to this pool in USDC, and then you can basically generate, like the market maker will generate yield for you on this pool because we'll just be using our own, basically like operating our own infrastructure in terms of like being a market maker. So it should help this, our protocol. I'm like IntentX because we have more liquidity there, and it helps the community that are LPs because they can basically gain yield on their USDC through this market making activity. But in order to get access to that, you're going to need to have, and we haven't talked about any numbers yet, we're going to need to have some INTX staked. Yeah, so I'm not sure that I can divulge what the FDV will be when we launch, but it's but for our seed round, we raised a $12.5 million FDV, and it's not going to be, uh, like 5x that by any means. So it'll be at a relatively modest valuation above that. Yeah, it's a really good question. So I think that like really what uh, this infrastructure allows us to do is offer anything that market makers are willing to hedge. And so what that means is basically like, yes, we can absolutely offer commodities or different types of derivatives. And really what it depends on is, do we have a market maker to basically uh, you know enable that liquidity to go off chain. And so really we can support anything our market makers support. So you can imagine if we have a market maker that can, you know, trade stocks or commodities or REITs or whatever, we can offer that on our front end and kind of facilitate people on chain being able to trade derivatives on those assets off chain. Yeah, I see what you're saying. Yeah, there is a distinction there. So basically what you're just depositing when you deposit into an account on IntentX, you're depositing into basically like the trading engine or the L3 that is Simio. So you still have like you're the sole owner of those assets. They're just now in a contract on a different layer. So nobody has access. I guess the point is like nobody has access to those assets aside from you, but they're now in a contract as opposed to just sitting idle in your wallet. Yeah. Yes. Yeah. Yeah, I would say so. But I mean, I guess if you're like, I'm trying to think of like if you, yeah. I'm trying to think because it is different. You're right. Like if you trade on GMX, like once you deposit into that trade, like you are like I'm trying to think. When you deposit, your collateral goes into a contract. You're at risk there, just like you would be in our system. But in our system, maybe you deposit more than you're trading with. So I don't know. Do you see what I'm saying? Like GMX, I feel like you're really doing the same thing with these other AMMs. Right. Yeah. No, yeah. No, definitely. Yeah. No, please keep asking. I love it. Yeah, and you're right. Like it is there is definitely like smart contract risk for sure. I will say that the contracts on Simio have been audited by Sherlock, um, and they have an ongoing bug bounty. So those are heavily audited contracts. But yes, definitely still risk there. Yeah, it's a good question. Yeah, those are all kind of kinks that we're basically like in the stage that we're in now. And if you or anybody listening who's trading on IntentX, if you guys have issues like that, please come into our Discord and put it in the suggestions channel. But yeah, we're working to get all of that type of stuff ironed out. And really like the phase that we're in right now is trying to get like as much feedback as we can. Like you're not going to hurt our feelings, but please give us as much feedback as you can, and we're trying to like implement that to just make the UI UX much better. Yeah, so yep, definitely. So that has to do with the account abstraction. So right now that's kind of not enabled yet. But the idea is that in the future, basically like one thing. So these are two separate things, but they're kind of I don't know how to say this correctly, but there's two separate things here. One thing is that with the account abstraction, you can pay in any ERC20, so there still is gas being paid, but you don't have to have the native gas token. So that's one aspect. But the really with the gasless aspect, basically what the account abstraction wallets enable us to do is it enables gas to be sponsored. And so what that means is that IntentX, the platform, or market makers could go in and sponsor user gas. So they're not actually paying a gas fee, but the other party is. Yeah, good question. So on the development team, we have four, I think. And then marketing team, marketing and operations, there's three of us. And we have a design team, which I think there's another two there. So I think between 9 and 10 people. Yep. Yeah, it's a good question, and one that we get a pretty decent amount. Well, what I'll say about that is the the Simio team has been building this infrastructure specifically since 2021, and uh, from working with Lafa from their team, I can say with firsthand experience, like he was very apprehensive to push anything out prior to the Sherlock audits going through and going through multiple iterations. So I think that they're um, taking a very serious approach to security. And I think you're right, like lessons learned, right? Um, so from our perspective, the Sherlock audits look really good. We have a good relationship with the SIM team and Lafa from the SIM team. And so we're confident in the work that they've done. And in addition, like in terms of we've tried to keep the architecture as simple as possible on the back end because really most of it is facilitating this peer-to-peer trading. So they're trying to keep as little logic there as possible and trying to offload a lot of that to the front ends like IntentX. And so anyway, I think what I'll say is that I am personally, I can't speak for everybody else, but I'm personally confident in what they've produced and confident in the Sherlock auditing system. Yeah, it's a really good question. One area that I'm really interested in is gaming, so Web3 gaming, and I think that so far it's been uh, in my opinion, again, I'm only speaking for myself here, is it hasn't been very successful because a lot of people are trying to slap a token onto a game, and ultimately that causes like an immense amount of friction because if you have in-game transactions and things, people have to go to their wallet and be able to sign, and if you're on Ethereum, you have to pay high gas costs to do that, and sometimes it takes a while for the transaction to go through, and so so far the gaming, like the Web3 gaming experience has not been very good in my opinion. But I think that with all of these layer twos coming online and the infrastructure that's being built with account abstraction, um, I think that we're getting to a point where now the infrastructure has caught up, or will be caught up relatively soon to see some really cool experiences in terms of gaming and having it be minimal friction or frictionless to the end user. And so I think that uh, in the next, year or two, and as the next cycle comes around and some of these AAA games get released and the infrastructure has caught up, like we're going to see some really cool stuff in Web3 gaming. That's something I'm interested in. I like a Yeah, yeah, it's a good question. I like Parallel, I like Illuvium, kind of like the bigger ones that are have had good uh, funding rounds and are building some like really quality stuff. Yeah, so I'm actually not super familiar, but I've heard that from a number of people now, and it's something that I need to check out. And like what I've heard is very good things. So it's something that I need to check out for sure. Right. No kidding, man. Yeah, no, it's something I need to check out. Another project I like um is a project called Hatchieverse, and they just do things a little bit different. Like the way that they have um basically what they're trying to do is like the token and DAO governs the IP of the characters that they've created, and they've got like all of these assets for these like monsters that they've created. And the idea is basically like as a game developer, you can come in and use those open source assets to build your own product, and then if you create a product like a game or whatever product using the IP, if you make over $300,000 a year, you pay 10% of your revenue back to the token holders. Um, and they're in the process of creating. Actually, they're going to be releasing two games soon, made by different development teams, and with their assets that they've created. Um, and the games are solely Web 2, like have no Web 3 component, but again, like will feed back into this kind of like flywheel depending on the amount of revenue they make. So I think those models are like super interesting too, where it's not necessarily like a Web 3 gaming experience, but it's tied in with Web 3. Yeah, yeah. Thank you again so much for having me. Hopefully, I didn't ramble too much. Sometimes I have a tendency to do that, but yeah. Okay, okay, great. And yeah, hope to see you guys using the platform. And like I said, please, give us any feedback in our Discord. We're happy to kind of like address people's concerns. And if you have an issue, please open a ticket. And then, Kyoto, if you want me to come back later on, just let me know, and I'm happy to come back. All right, guys. Happy trading.